Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. So today in this lesson, we're going to talk about the option Greeks. What are they? How could we use them? What is the major factors of them? I'm going to give you a couple tips and tricks of pretty much the ones you should really care about and the ones you really shouldn't care about. But it is always good to understand what the option Greeks are, right? And because you'll start to see how the Greeks actually really talk about the overall markets themselves, right? Or the option pricing. So let's jump right into it. The Greeks, we have delta, gamma, theta, vega, and rho. The Greeks are going to determine the rate of change in the option price by the change in the underlying stock price movement. Okay, so first off, which I personally think is the most important one and the one you should always use and have is the delta. Okay, the rate, what is the delta? The rate of change of the option versus the stock's price is the rate of change in the option price for every $1 move higher or lower of the underlying stock price. So for an example, if the option is at $2, okay, this is the option pricing, and has a delta of 40, and the stock price moves from $20 to $21, then the option value will rise to $2.40. So let's kind of break this down. Think of the delta as two things. The very first thing is the rate of change for every $1 move higher or lower in the underlying stock. So if a stock price is, we'll say $20, okay, and we buy the $20 delta, okay, and let's say that delta has a 0.40 delta, okay, delta can only go from 0 to 100, so let's say it's at 0.40, and the stock moves $1 higher, you will make $40 on the option price. Now, if the stock moves $1 lower, you will lose about $40 on the option pricing, okay? So that's how we get the 0.40 if we move for $2, right? If we move $1 with a 0.40 delta from 20 to 21, then the option value would rise from $2.40. Okay. So that's the first thing with the delta. And another really easy way to understand delta would be think of the delta as a percentage, right? So the delta has a 40% chance of closing in the money. So let's take a look at Viacom over here, okay? And let's look at what the delta, here's our delta, okay? And almost all the time, whenever we are right at the money, so right now the stock's at $40.73, okay? Well, there's no 40.73, right? We have 40, 50, 40, 41. Well, 40, 50 is probably the closest one, right? Because it's 23 cents of the money, and this has a 52 delta, okay? Which is, sorry, a 54 delta. Okay, the 41 has a 52 delta. Now, implied volatility also falls into all this, but just to keep it simple, the delta usually at the money is going to be about a 50 delta, right? So if we come all the way out of the money to 43, the strike price, right? And we're at 40.73. We're about $2.27 out of the money. Well, that has a 41 delta, right? So if you bought that and the stock moved $1 right now, we would make about $41. But also think of it as, what are the odds of this option expiring in the money? Okay, above 43, well, it's telling us it's a 41% chance, right? So that's why at the money is always a 50-50, flip a coin, right? Because it could go up or down, and that's it. So, so hopefully that kind of helps and makes sense. So that is the delta. Next, we have theta. This is the second most important one that you should really know. Theta, the amount an option will decay over time, is the change in the option's value of time decay. Time decay is the loss of premium or value on a daily basis. So let's say that the theta is at 0.2, okay? If the stock price does not move that entire day, you will lose about $0.2 cents worth of option value or premium if you are long the call or put. So let's go back real quick, and over here we will add, under volume, let's add theta. Okay, we could see with 29 days left, theta is about 5 cents. Okay, so every day, if we just go sideways from today to tomorrow, what is between, in the mid price, we'll say is 273, okay, 272, well, you would lose about 5 cents of time decay. Okay, so because remember, theta is only affected by extrinsic value, not intrinsic value, right? Intrinsic is something we'll go over later on. Well, let's go over extrinsic and intrinsic real quick, right? So let's take a look at intrinsic value and extrinsic value. Okay, and as we could see with intrinsic value, out of the money zero, there's zero value to it, right? But as you go deeper in the money, that is kind of like, think of it as deep in the money. So if we go look at the 40, I could tell you there's 73 cents. Now, over here, that's going off the bid ask, but if the market was open, it was a penny wide, we would have 73 cents of intrinsic value, right? So if the stock expired today, let's fast forward, nothing changes, and we expire today, there is 73 cents of intrinsic value, right? And we could see it right here, 73 cents of intrinsic value. So what you paid, let's say 324, is only worth 73 because you have the right to buy that at $40. So I hope that helps. And that's what extrinsic and intrinsic is, right? So intrinsic is in the money, extrinsic is out of the money. Think of it as just pure time decay, right? So anything outside of intrinsic is just price hasn't reached there yet. So that is all just premium. So going back, okay, so Theta is essentially, the problem with Theta and being long a stock with Theta is it hurts you over the weekends and when the market's not open, right? Because if you're long a stock, Theta works against you because it's going lower, right? It's decaying. Think of it as, I hate to use this analogy, but a dead body, right? Every day when it dies, every day it's going to decay more and more, and eventually it'll decay all the way to nothing. Right? So now think of it as 2% of the body is going to decay, okay, every day. And as time speeds up, it goes quicker and quicker. So it is, you get closer to expiration. So that is essentially what Theta is. Theta is really good because you want positive Theta when you are selling options. That's why the secret sauce to options is, yes, you can buy options. They're really good, but also selling options, because over the weekend, if you're short options, right, you're a seller of options, you're collecting, you're making money because the market's closed and time is going by. If you're long, you're losing money. So that's a good way to really understand Theta. So let's go to the next one. These next three, I'm not going to lie, I don't care for them, but we'll go over them. But the only two you should really, really care about is the delta and the theta. Okay, those are the only two that I ever use. Everything else is just more math of how it all works based off other factors, but it doesn't really help you in anything relevant, I believe, in my opinion. But let's just go over gamma. The change of the delta's delta is the change in the is the change in the delta's price for every $1 move higher or lower of the stock price. So an example is, if the option delta is 40 and the gamma is 3, and the stock price moves from $20 to $21, then the option delta will move up 3 cents to a delta of 43. And that's why if we come back here, okay, and we come back to the delta, we see that the at the money, right, out of the money is 52, the in the money is 54. Well, if we were to move another 25 cents, that would probably go to 56 and that would go to 54. Okay. And that's essentially what the gamma is. So if we come over here and we look at, where is it? The gamma, right? You have a 5 cents. So a $1 move would put us up to about 59 cents, and that would put us to about 6 cents. So that would put us at about 58 cents, give or take. But remember, all this is changing in real time. So that is the gamma. Next, we have Vega. Vega is a volatility changes, okay? Is the change in the options value based on the change of the stock's volatility. So Vega is as implied volatility, and we'll get that into later videos, what volatility is and all that, but it's just the change based on the value of implied volatility. It helps the change of the option pricing. And then finally, we have Rho. Rho is interest rate changes. Okay, so Rho is the change in the option value based on the movement of interest rates. Okay, so as interest rates move up or down, that's actually going to help move the option pricing up or down. But remember, Rho, it's irrelevant because it's not like interest rates are always changing, right? They change once in a great while. So that's it. That's the video on the Greeks. Hopefully this was helpful for you guys. And the next video will be really interesting. And again, hopefully all these videos are real interesting and you just really kind of start to learn and understand what the options are, how they work, and you start to become a master of them. So until next time, we'll talk to you soon.